Hello, and welcome to Portfolio Matters Week 9 Weekly Update. And this week, I'm reminded of the old Chinese curse, may you live in interesting times. There has been a hell of a lot happened this week, and this is going to be quite a long weekly update. But before we get into it, Richard will read the disclaimer.
Thanks, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Okay, Keith.
Thank you, Richard. So it was an eventful week. Obviously, the main subject for UK investors was the budget, which I would say was pretty benign for investors. Corporation tax will rise to 25% from 2025, from 19% that should be, which obviously will hit as and also personal income tax allowances and the pension lifetime allowance will both be frozen. So as inflation rises, the effective tax rates, everyone's effective tax rates will rise. But the good news was CGT rates remain unchanged. In other news, OPEC Plus have met and against expectations have decided to leave April output unchanged. So despite the rising oil price, they're not going to increase their production. Remember, they have 7 million barrels of spare capacity. There are some minor tweaks, so Russia can increase by 130,000 barrels and Kazakhstan by 20, but that's it. So the oil market will remain tight, and we will cover that. The big news yesterday was Jerome Powell made comments saying that he would be patient in withdrawing support for the economy, which means that he was going to let interest rates rise. He was not going to intervene, and that has big implications. And Joe Biden is continuing to try and get his $1.9 trillion stimulus bill through the Senate. Now, I am very concerned about that, in that you'll see as we go through, inflation is rising. The US economy is doing well as it is.
And also, one of the things there, Keith, I think he's very bullish on infrastructure work and renewable energy, isn't he? Which is going to put greater pressure on commodities.
Absolutely. So briefly going through oil. Now, what are Saudi Arabia up to? They have loads of spare capacity. The oil price is back to levels at the height of the last cycle. And I think what's going on is Saudi Arabia are under some geopolitical pressure. You've seen the Biden administration are looking to recalibrate their relationship with Saudi post the Khashoggi assassination, and Saudi Arabia are flexing their muscles because they can. And they are obviously, they like a high oil price, but the bottom line is taking a lot, millions of barrels out of the market is costing them money.
Keith, do you suppose one of the reasons they're doing this is that Biden's applying pressure on them so that he can get his shale oil back to full capacity?
Well, the thing is that
point of view?
I don't think Biden is, because Biden doesn't like shale. He has restricted shale drilling on federal lands and has imposed these environmental standards so that reducing methane gas flaring, which the shale oil wells currently do and is a big contributor to global warming.
Right.
And he's saying they can't do that, which raises shale costs. So I think, but he has obviously released the report blaming the Saudi crown prince for the Khashoggi assassination. But anyway, at this stage in the cycle where there's spare capacity, Saudi Arabia are in control of the oil market, and I think they're just letting everyone know. But if they don't start increasing oil production, the oil price could get out of control, and which would, in a way, that would be very bad for the world economy. So watch this space. In my view, OPEC need to start increasing oil production. And this, you can see, this is the oil price over the last 25 years. And the oil price is now $65 for WTI, is approaching the peak of the last cycle.
Mm-hmm.
And this chart shows the US petroleum and crude oil reserves, their stocks. And the red line is where we are now. The yellow line is last year, and you can see last year US petroleum and crude oil stocks hit an all-time high. Yeah, and that means there's too much crude, prices are going to collapse. Now the stocks are heading back towards their long-term average, but falling quickly. Unless the Saudis start increasing production, the danger is this red line goes through the long-term average and heads down towards the lows, at which point people become really quite anxious about petroleum stocks, and the oil price starts to rise quickly.
Mm-hmm.
Okay, moving on to interest rates and inflation. Now, I thought this was an amazing chart. So, bottom left, in percentage of GDP, is the fiscal stimulus applied by the US in the last 4 recessions, going back to 1973-76. And if you add the total stimulus up over those 4 recessions, it added up to less than 12% of GDP. The COVID recession, they have done 18% of GDP in 1 year. Absolutely astonishing. And at the same time, they've applied unprecedented amounts of monetary stimulus.
Mm.
Richard?
So this is a graph showing UK household deposits in bank accounts for the last 20 or so years, Keith. And it's roughly been an average monthly change of £5 billion. And in the last 6 to 8 months, it's rocketed, and the quantities of money in UK household bank accounts now is vastly greater than it has been. And once the presumption is that once lockdown ends, a lot of this money becomes available to be spent on consumer activities, and that may well lead to a very significant increase in inflation, particularly since there have been marked cuts in supply, particularly in leisure services.
Mm.
So the danger is that we move to a very inflationary environment very quickly.
Absolutely. And this chart just backs that up, and it shows it's not just a UK phenomenon, it's worldwide.
Yeah.
Consumers personal savings have gone through the roof. And so when people are allowed to come out of their houses and actually spend money, there's a tsunami of personal savings about to be spent.
Yeah.
Now, this chart shows the relationship between inflation and the P ratio. And the bottom line is, as inflation rises, so the P ratio declines. And we are here. So if inflation picks up, expect the P ratios to decline, certainly towards this norm. So,
and of course, the reason for that is that investors expect a higher relative return if there's inflation, in order to make an after inflation return on their investments.
Yeah, absolutely. So do your own research, but the bottom line from this chart is sell technology, sell very high P ratio stocks, because the discount rate for future earnings is rising. Richard?
Well, Keith, this is the chart of the US 10-year yields over the last 30 years. And they have been in this continuous fairly broad downward trend. They bottomed in about April, I think, didn't they, of 2020, and they are now in this uptrend. Whether it's a corrective phase for the continuation of the main downtrend or not, only time will tell. But if interest rates on this basis, if they go up to the top green line, they would probably hit around about 2%, which would be a massive percentage increase from where they are now, and could have a very deleterious effect on valuation of many assets, as the discount rate used more than doubles. And that's what we're seeing in the tech sector. And we're probably seeing it in precious metals. And we could continue to see it in the valuation of all sorts of assets.
Absolutely. And I think that we're now in a regime change. So we are going to see structurally higher inflation. And 2021 is already one of the worst years in history for bonds. I mean, bonds were so overpriced. This should come as no surprise. But we talked earlier in the year about, how you should be. We had sold all our bonds.
Yeah.
And that's proved to be prescient. Now, one of the side effects of rising rates are that mortgage rates are rising, and they are rising quickly. So the last week we talked about rising US mortgage rates, and our viewer Herman then slightly corrected us by saying that what we were showing, the graph we'd shown, was of mortgage-backed securities, and that we needed to show real rates. So here we are. So the blue line is the 30-year, and the orange line, sorry, the purple line is the 15-year. And so mortgage rates, that's right, sorry.
I was, sorry, Keith, go on.
No, you go, Richard.
Well, there's an article in the Financial Times this morning, which basically, the question being posed was, is the UK housing market too big to fail? In other words, the economic value of the housing market is so large that any decline in its overall value will have a devastating effect on the economy. And of course, as interest rates go up, one of the corollaries of that is property prices drop.
Absolutely.
And our central banks and governments now beginning to face another dilemma, which is housing markets which have become too big to fail are in jeopardy from rising interest rates.
Yeah, absolutely. You see, the whole setup of the economy is fragile. We've got so much debt that as interest rates rise, it will start to suck demand out of the economy. So rising mortgage rates will reduce demand for housing.
And also, I think one of the pricing points for the housing market is the rental sector. So if you're happy to get if base rates are very low and you want a 4% return on your rent, that effectively sets the price ceiling for the rental sector of a property. If you want an 8% return, then the price ceiling of your property halves. And in some senses, the rental sector is the marginal price setter for the property market. And my belief is that as interest rates rise, then that valuation ceiling set by the rental sector will drop.
Absolutely. Higher rates should lead to lower property prices.
Yeah.
And on inflation, rising commodity prices are a precursor to inflation. So the salmon pink line here is the copper price, which has been shooting up, and core inflation is lagged by 2 years. So you see that 2 years after copper price shoots up, you get an increase in inflation. So inflation is coming.
This is an interesting quote from Albert Edwards, who's a very well-known former global strategist for Societe Generale, who said, although I think we will ultimately move away from the Ice Age deflationary quagmire, the reflation trade has gone too far, too soon. After a now fully discounted half-one GDP boom, which we are expecting, a growth and inflation slump towards the end of this year will likely trigger sub-zero US 10-year rates. So what he's saying is that graph where there was a tick up in the price of treasuries is going to come back down towards the bottom end of the channel. And if that happens, then everything that we're seeing at the moment in terms of tech stocks and precious metal valuations and disruption to valuations generally will go into a massive reverse.
Well, I think we absolutely need to be nimble on our feet in case that happens. But I frankly completely disagree with him. I think he's wrong on this. I mean, there are vast amounts of savings which we've seen. People have resources. You know, what he's talking about is if interest rates rise very high very quickly, then yes, you could push the economy back into recession, but I just don't see it. You know, obviously, if that arises, we will cover it live, but you know, that's a long way off.
I think, Keith, we're in a situation where if interest rates rise, we get huge valuation problems, and we get things like the too big to fail housing market issue looming. If interest rates fall, we lose all price discovery, and what appear to be absurd prices continue to increase more. So the central banks and politicians are trapped, and in some senses, you know, we have no idea which way it's going to go. But as you say, we have to be very nimble so that we don't get caught on the wrong side of this.
Absolutely. So, on that note, US PMIs looking very good. You know, Eurozone PMIs looking very good. World trade volumes almost back up to their pre-COVID highs. Now, the one negative is that the Chinese PMI seem to be coming off a bit. You see, they are the yellow squares, and the last two are not so good. So the question is, will that be bad for commodity prices? Is copper getting ahead of itself? Frankly, this was a chart from Monday and it's already out of date because copper's come off 8% in the last few days. I mean, we are really living in interesting times in the market. So moving on to the checklist, equity markets. Generally a bad week, although topics did well and Bitcoin was up. Richard has a lot to say about Bitcoin this week. Industrial commodities. So you can see that a very mixed bag. Copper came off 9% from highs, but iron ore continued to tick up. Neodymium had a great week, up 11%. Now nickel crashed. Nickel was down 18%. Now, if you remember from earlier episodes of Portfolio Matters, we discussed that nickel actually has a structural oversupply problem for the next 4 years. So we were puzzled by its strong outperformance, but it's come crashing down to earth. And finally, oil, you know, great week on the back of OPEC plus.
I noticed, Keith, as we're recording now, oil is above $65 a barrel.
Yeah. I mean, I don't know what targets. See, OPEC can set the price of oil, but they don't want to send it too high. You know, they've got to start reacting. Copper, you know, off its highs, but it's still done very well. Nickel, not great. So Citi are saying that the collapse in the nickel price is that Chinese supply has increased and Tesla have made efforts to reduce the amount of nickel in their batteries. So
Tesla has also sourced all of its nickel now going forward from New Caledonia.
Okay. Thank you, Richard. But this is comparison of the current bull market in copper compared to previous ones. And
so can I just point out that the present line is the small green line that ends at about time point 8.
Yes, yes, exactly. So what this chart is saying is that the copper bull run could have a long way to go.
Yeah.
Who knows? Okay, moving on to precious metals. Generally a bad week. Gold down heavily, silver down heavily, platinum down heavily. Rhodium continues to go through the roof, and you can see here a real gap between the performance of industrial metals, rhodium and palladium, and the safe haven metals. If we look at, sorry,
I was going to say, Keith, that one of the main producers of rhodium is Sylvania Platinum.
Absolutely.
We did a share talk on, you did a share talk on, and the price of which I think is doing quite well at the moment. It continues to do well despite the drop in platinum prices. And if you go back to our share talk on Sylvania, you'll see why it is so benefited by the rhodium price.
Absolutely. And rhodium is mainly used in catalysts to convert various nitrous oxides into nitrogen, and so reduce pollution. And in 2022, the EU are tightening standards. So
I also think the Chinese are also in the process of tightening their emission standards.
Yeah. So this is rhodium. It's absolutely going through the roof. Now, Goldman Sachs are forecasting it could hit $100,000 an ounce this year. And I was deeply skeptical, but, you know, I could be wrong at this rate. Gold had a bad week and on rising interest rates. And frankly, everyone is bullish on the economy. So I think safe havens are less in demand. Silver, silver had a bad week, but, nowhere near its medium-term performance has been much better than gold. Same with platinum. Moving on to rates. Now, UK rates were actually pretty flat on the week. But if we look at the 30-year, you'll see that, it's potentially got a long way to go. It could... we are looking at the 5-year average. The 30-year rate should be well above 2%. And frankly, I expect it to head much higher than that on the basis of personal savings being so high. Richard, do you want to go through your personal activity this week?
Yep, I'll do that, Keith. So this week, for the week, I was down 2.6, which puts me 3% down for the year. I made 2 purchases. I followed Keith into Hunting PLC. This is the oil services company, which Keith did a share talk on earlier this week. And I also bought shares in a US oil company, Diamondback Energy, an independent oil and natural gas company headquartered in Texas, focused on the acquisition, development, exploration, exploitation of unconventional onshore oil and natural gas reserves in the Permian Basin. And this is their share price, their price graph, and weekly price graph. And I thought that the price action was looking very positive indeed. And I sort of thought this was a bit of a momentum trade. So my view is the oil price is going to continue to rise for some time, and that a lot of these companies are undervalued. I think that I also noticed in the Financial Times another article which basically was saying that pension funds that have exited fossil fuel investments on an ESG basis are being urged to go back into them because the companies in question need them in there so that they can continue to operate and develop their businesses. And so there's a clear economic benefit in doing so in terms of their dividends as well. So I just think that we're sort of in the midst of this very strange rotation around ESG, and at some point sanity will reassert itself.
Yes.
So sales, I sold most of my Bitcoin and Ethereum. So my concern has been that they have come very far, very fast. That the low interest rate environment probably benefited them. That the surge in tech prices probably benefited them. And whilst I still believe that disintermediation and blockchain technologies are the software of the future, are the way that many transactions that are currently performed in other ways will be performed in the future, we are at a very early stage of that process. And my feeling is it's a little bit like the internet in 1999. Other people have said this. Yes, the internet was the thing of the future, but in 2000 we had the tech crash. And my view is that it's come very far, very fast. The gross valuation is over $1 trillion. There are a lot of issues around it. And I thought at this point, discretion was a better part of valor. If the price falls back down, I will probably re-enter it at some point. But for now, I feel my risk-reward ratio was skewed far too far to risk and not enough on reward. And time will tell if I'm right.
Well, very well done, Richard. I think you have to take profits at some stage, and that has been a phenomenal trade for you. I would remind viewers that Richard made 70% last year, far outperforming me. And I think that rising interest rates will be a headwind for cryptocurrency. So very well done.
Thank you, Keith. So as you know, I keep my eye on the uranium price out of curiosity, and the spot price is continuing to drop. The shares in the Geiger Counter Investment Trust, which invests in uranium, not reflecting the drop in prices, as neither are very much the uranium miners. There is a structural shortage, I believe, we are heading for one in uranium. We don't know when it's going to be, and it's been on the horizon for many years, but I believe it is there. So at some point, these uranium miners, will give a serious return.
Well, can I just come in there quickly, Richard? And the trouble is, we have discussed this before, but people have been talking about a shortage in uranium for a very long time now.
Yeah.
And I am reminded of the episode in Reminiscences of a Stock Operator, where Jesse Livermore follows the advice of a corn market expert and sells a load of corn short and promptly bankrupts himself. And he, the lesson was actually the only thing he really needed to do was follow the price. And all the information is in the price. And right now, the uranium price is drifting off again. So, I just don't see it. Sorry.
That's very interesting. And, a dose of reality, Keith. I think you're right. It's something one has to be careful of. I would suggest to anybody listening, if they haven't read it, The Reminiscence of a Stock Operator is a magnificent book, and you really should read it. And I think Jesse Livermore doubled down on several occasions, didn't he, before going bankrupt?
He did, yes, sadly. Yeah.
So lithium, Keith has, I can't remember if you mentioned lithium. Keith, the price hasn't changed on the week. The price of Zinnwald has gone up very slightly.
Very good.
And we've covered that. Silver's, Keith mentioned that silver, it's in a range. It is an industrial metal. I've worked out a better way of monitoring what's going on in the silver supply-demand stakes, which is to look at the larger bars at bullion by post, which have remained in stock throughout this whole period. And what's been out of stock has been the coins. Coins obviously take more fabrication. But if you look at the 5 kilo bar, for example, and smaller bars, they are all in stock. So probably a better reflector of the silver supply-demand situation is the bar rather than the coin stock. And that's me, Keith.
Thank you, Richard. Okay, well, I had a decent week on the back of OPEC. Thank you, OPEC. You saved my portfolio this week. So I was up almost 1%, which takes me up to plus 4.3% on the week. But I had another busy week. Regular viewers will remember that I have been systematically selling my gold over the past few weeks. And actually, I sat down this week and I thought I should sell my gold producers as well. So I sold almost all of them. I sold the iShares Gold Producers ETF. Frankly, I was up loads on that previously, but I've got out. And in general, I think that I've been slow to realize that I needed to get out. But once you do realize you need to get out, whatever whether in profit or loss. And so a lot of these companies I bought when gold was much higher, and it's drifted off, and I've made a loss.
Okay, so I'd just like to chip in there. So I have quite a number of gold mining shares, and I have made the decision not to sell them. So I am going to sit on, and the reason I've done that is because I find it psychologically difficult to buy back a share that I have sold, and I also struggle with the timing, and I don't know when I will think the right time to buy. So my concern is that I will basically miss the boat. I am convinced that gold will go up. I think it's a timing issue. So I am hanging in there. And part of my poor performance this week has been my gold and silver mining shares.
Right, it's interesting you talk about the psychology, Richard, because that's my psychology is that I hate seeing things drift off. And I know that if it drifts off further, I will get annoyed and I'll probably sell them. So I prefer to sell them now rather than sell them later when the losses have increased. But like Richard, medium term, long term, I fully expect the gold price to do very well. And I would get back in when I think that the time is ripe. Now, the only ones that are worth talking about here are Griffin Mining, which has a Chinese mine. And the share price has absolutely shot up because they got permits to increase the size of the mine, increase the resource area. And I've obviously done very well on that. The Petrofac, I had an interaction with one of our viewers, and basically the results have been delayed by 2 months. New management is coming in. And I seriously wonder whether they aren't going to do a kitchen sink, throw everything out, And we have when we did the share talk, which I urge everyone to see, we were concerned about the high levels of cash completely offset by debt. Why was the company running high levels of cash and high levels of debt? That didn't make sense. So I haven't sold the whole position. I've halved it, but I had essentially one sleepless night where I was just thinking about that cash. Yeah. Perhaps the cash isn't there.
Which was the company, Keith, where they took the shareholders to the cleaners with a huge dilution?
Well, it was another Middle Eastern company. Dilution.
Yes, the oil company that you did the share talk on.
The oil company.
Oil services, they were diluted by 85%.
Well, the Rambler Metals was the one where they diluted by 85%.
Oh, that's right.
Yeah.
So the fear would be another Rambler Metal style dilution, perhaps?
Well, actually, I think it's worse than that, Richard. I think that the worst case scenario would be another NMC Health or Parmalat. Parmalat, I don't even remember, but 15 years ago, as an Italian milk company that also had enormous amounts of cash and enormous amounts of debt. And then one day it was discovered basically the cash didn't exist. And why would you have loads of cash and loads of debt? Okay, so this is Griffin Mining. Shares have absolutely shot up. And I waited until I thought the shares had peaked. They're peaked. So out.
Well done, Keith.
Yeah. I had a lot of losers on that particular, shares I've sold, and it's nice to have a winner. Okay, so what do I buy? Lots of these purchases will be familiar to regular viewers. So I bought some more Anglo-Pacific. I really like Anglo-Pacific. I bought a load of bank shares because interest rates are rising, and that is their profit margin. I bought some more Hunting. Entech Upstream, which we covered in a share talk. They announced during the week that they are launching their game-changing rotatable steering system for directional drilling. Frankly, I think this could be absolutely transformative for this tiny company, and I own more of this company than I should, because it is tiny, and my relatively small position is actually getting to be a meaningful amount of the shares outstanding. So anyway,
you have to declare your interest soon.
Well, it would come to the point where I might have to, if it carries on like this. I've been picking up a few shares every day. Anyway, so that's the share price of Entech Upstream, and I think there is a lot of upside. Now, the one gold miner I have retained is Platt. Now, Platt announced their H2 2020 results this morning. The bottom line is share price is 7p, and they had fully diluted earnings of 1.2p for the half year. So then a P ratio of 3. So if you're interested in this company, I urge you to go and have a look at our share talk on it. And I think that's it. It's been a long slog this week. Lots going on.
Well, thank you very much for that really interesting update, Keith. And thank you very much, everybody, for listening.
Absolutely. I hope you will press like and subscribe to our channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.